Who wants to start? Who's got the first question? Nobody? I can sort of tell you how I got to where I am as far as finances goes. Quick story of my life from the financial point of view. I'm sure you're not interested in the rest of it, and we can see where that goes. So, and if anybody has any questions, either pertaining to my story or unrelated. Okay, so NM is saying, which is better to get, financial planner or a tax accountant, or both? So a financial planner is more about, they can handle investment recommendations, but it's more likely financial planning, meaning this is where you're going to be in 20 years and so on. A tax accountant, I think, is just an accountant then, and they might make recommendations as far as this type of investment will have these implications for your taxes versus another type of investment. If your investments are complicated, having an accountant is generally useful. If you have taxes from non-registered accounts, or from real estate, if you have expenses and so on, an accountant, I think, is a must-have. But I mean, there's a small amount of overlap between a financial planner and an accountant, but not a significant one. I wouldn't want financial advice or planning from my accountant, and the financial planner might have knowledge about taxes, or should have some knowledge about taxes, but would not be able to do your taxes in April each year. So in this case, both. You know what, when I first started out working and I was permanent, didn't have a business, and just had some RRSPs, I was doing my own taxes. I mean, it took 3 hours to carry the same number through all of the paper forms. Yes, it was that long ago. And it took a little bit of time, but it saved me $100. But as soon as I got a corporation, as soon as I got the US real estate, and as soon as I was running my own business, like I'd much rather pay somebody who knows what they're doing and they're not going to screw it up. I mean, you still need to check them, but I'm just saying, rather than do it myself, because it would be a lot of learning that I would have to do, and I would make mistakes, and then, if you have an audit or something, then that's certainly not worth it. So like my corporate taxes should cost under $1,000, and then personal ones I just paid $350 for. So it's not cheap. The corporate is much worse than personal, because there's just a lot more that they have to produce. But rather than,
You have to file American and Canadian taxes. So do you deal with the IRS?
I do. This is because of the real estate, not because I own US stocks, for example. If you own US stocks through a Canadian brokerage, you don't need to. I had US stocks in a US brokerage because I worked for Accenture, a US consulting firm, and they gave me some shares. So, and that was with, I want to say, JP Morgan in the States, and I never filed US taxes and nobody called me on it, but they could have. But as soon as I got real estate, you have to get yourself an ITIN, individual tax identification number, which is kind of like a social insurance number for those. Well, US version is the social security number.
Security number.
Yeah.
Yeah, I have both. I have the ITIN and SSN. I actually work for an American company, and I have a work visa, and there's certain restrictions, and I have to file with both of them.
Yeah.
And it's fairly simple right now because I have an RRSP and some American stock. I don't own real estate in the US. All my stuff is in Canada. I have to fill out some weird stuff for the IRS,
Mhm.
but it basically becomes a wash because it's all in Canada. So they treat me as American filing foreign stock information. I'm like, I'm Canadian, but somehow it all works out. I don't understand what the heck I'm doing, but no one's complained for the last decade.
Yeah, the danger is that if you miss a form, then suddenly you're going to get fines.
Yeah,
Um,
and I work in different states and different counties and different cities, and I have to file with, like, when I was in New York, I had to file with the state, and I had to file with New York City, and then I had to file my Fed. And when I was in Texas, it was just Texas. They didn't care what county or city you're in, and yeah, it just gets really complicated. And I work all over in the U.S. Because we have offices everywhere.
yeah, yeah. For Canadian citizens and especially residents, that I think that's the more important part. Your residents. If you have U.S. real estate, you definitely have to do U.S. taxes. If you have significant assets in the U.S., basically, the I do have a extra U.S. accountant. So I basically do three taxes: Canadian corporate, Canadian personal, and US personal. And the US accountant charges me $700, which for what he does, I think is a little much. And as soon as I sell my last house, that's going to be the last year that I do US taxes, and I'm going to be so happy for it because um, Canada has a tax treaty with the US, and uh, Canada gives you credit for taxes that you paid in the US.
Yeah,
Uh,
I'm doing
but
that now.
yes, they're doing that now. And the only problem is the CRA chooses to make that as difficult as physically possible. They don't just take, hey, here's my US tax return, please give me this credit. They don't say, oh, here's the canceled check where you paid your US taxes. Okay. No, they actually need the assessments and statements from from the IRS. And if you want to get credit for the state taxes that you paid, then you need that as well. And they don't, at least Arizona, which I'm dealing with now, doesn't provide that. So um, US just complicates things. Let me just put it that way. For being next door, they definitely make things far more difficult. And so that is one of the reasons why I'm trying to get rid of the US real estate. Now,
For me, I'm kind of stuck. It's like for the past, I think 2 or 3 years, Canada's been giving me a hard time and asking me to get more information. And then I have to talk to the IRS and get certain forms, and they send it to me, and then I send it. And like right now, I'm getting collection notices from CRA because they say I owe them $16,000. I've sent them the appropriate forms, but the department you send it to doesn't allow you to get callbacks and never answer the line because they're so damn busy. So I've been calling them since like March. Um, I'm thinking I need an accountant, but I don't know who to find who would know how to do that Canada IRS um, treaty thing. And
I
how do I
think
find an accountant that knows how to do that?
uh, I mean, I ran into a Canadian accountant uh, that does U.S. taxes as well. So I mean, he's local to Vancouver, but um, I mean, that would be one. Generally, other than the US accountant having to do the taxes first and then me just sending the PDF over to the US, sorry, to the Canadian accountant, there doesn't really seem to be that much overlap, and it's just getting the credit. Um, I seem to be able to write off the same things on both sides of the border, so I mean, you get credit for that. Yeah, cross-border accountants would be, yeah, you should be able to get somebody in your area. I mean, you can do it remotely too.
Yeah,
Um,
I just often didn't know what to look for. That's actually really helpful knowing what to Google for.
yeah, I certainly wouldn't want to do it all myself. So the
It
thing
wasn't
is,
too bad. It's just recently they're being a pain in the ass. And with the pandemic, it seems to be harder and harder to get in touch with them.
yeah, yeah, it could be. Um, with having to provide the proof that's been going on, I think about 4 or 5 years that I recall. Um, the thing is, as long as you're able to get the credit for it on your taxes, you get the tax discount and you either get money back or you pay less, and then they start bugging you and they say, we're going to disallow this unless you provide proof. You're like, well, I already have the money, so now I can take 3 months to get the proof, and as long as I get the proof to you eventually, then you're okay.
Yeah, that's what I'm at right now. The
Yeah.
last time I did it, I got the proof to them. Everything seemed to work out okay. This year, it's they gave me the refund. I sent it to the IRS. I paid the difference, and then I got a letter from the CRA saying, no, no, we want that money back." And now they sent me to collections, and I'm
Yeah.
like, um, the other, like, can't you talk to the other department? Because the other department says we're working on it. We'll get back to you, and they've been saying that since March.
But as long as they do give you credit for it, then they'll roll back all the penalties and so on.
Hope so. Yeah, I'm hoping it goes easier. It's just, it's such a pain in the butt. It's like I'm trying to do my job and I have to deal with this. And it's often like, call them, leave them on speakerphone while I'm working. And then when like someone comes online, it's like, oh, now I have to interrupt what I'm in the middle of to talk to CRA.
Well, but an accountant won't help you with that. You'll still have to get the documents, except sending them to the CRA. You'll send them to your accountant, who will then in turn send them to the CRA. So you won't save any
Mhm.
time that way.
Okay.
Um, yeah. So, but yeah, I can't wait until that stops, because getting the appropriate assessment information from the IRS is just a pain. And each year, I'm like, I'm going to be on hold for 2 hours, and then they're going to disconnect me, and I'm going to try it next day, and again they're going to disconnect me, and it just becomes very frustrating.
Yeah.
This past year, they said, "Oh, we can authenticate you, and then you can get the assessments yourself." And I went through a whole bunch of trouble to get authenticated. Actually got on live with somebody who authenticated me when I
Oh,
showed
is
them
this
my
the
passport.
IRS
This is
authentication
the
thing?
IRS, yeah. And
I
then
tried that and it messed up. So
and
now I can't get authenticated.
I couldn't even, well, I got authenticated and then I couldn't even log in. And they're like, sorry. And then it was okay, back to going on the phone, which didn't work after wasting hours and hours. And eventually I just emailed my US accountant, who said, yeah, in a month, sign these forms now, giving us like power of attorney or whatever it was. And in a month, we'll get those assessments for you, and then you can pass them on to your Canadian accountant. We'll pass them on to the CRA, and then the tax treaty loop is complete. And I'm like, you guys just made it so difficult that I
Well,
just don't want to have anything to do with the US. I guess you have
I've
to.
been doing it for like the last 3 years. Like they only started doing it to me in 2019. For some
Yeah.
reason, they decided to start doing this to me
Yeah.
then. They hadn't bugged me for 7 years, and now they all of a sudden did. I don't know why. Maybe they just randomly only do a select number of people in Canada. I
No,
don't know, but I,
everybody who applies for it, they disallow it and they say, give us proof. So anyways, let's move on. So Deborah was asking previously whether you can switch mutual funds from A series to D series, and apparently you can do it without a tax implication. So thanks, Deborah, for following up on that. So yeah, some things you can, some things you cannot. Um, so you can switch series without it being a taxable event. So that's good. Question from NM: how did you get to financial independence or retire early? Um, so that was going to be my life story. That's going to be a bit of a longer thing. So let me get to Deborah's stuff first, and then I'll launch into my Odyssey. Deborah's asking, any thoughts on TD brokerage just to park mutual funds, good or otherwise, ETFs? I'm thinking over on Wealthsimple. Um, I've never used TD. I know for stocks and ETFs, there's commissions of like 9.95. Mutual funds, I'm guessing they still let you do for free. So if you want to do that, you can. If you have a checking account with them, it'll be easier to um, it'll be easier to transfer money back and forth. It'll be instant instead of taking a couple of days. Um, I have a friend who uses TD, and I don't remember him particularly complaining about it. Yeah, for mutual funds, it should be fine. Just make sure that they don't charge the same trading commissions that they do for stocks or ETFs. Stocks and ETFs, I would definitely do in Wealthsimple. Okay, so how did I get to financial independence? So I actually, people also ask me, do you think you could have done anything differently in your life as far as finance goes and investing? And I don't really think there is a heck of a lot. I'll touch on maybe a couple of things, but so I graduated university in the late 90s, 96. And because I lived at home and had a scholarship, I actually had money saved from a couple of co-op jobs that I worked during university. So I was lucky. First job, I got laid off after 3 months when the company got bought out. Then I started working in tech support for software, which I stayed just long enough to get stock options. And that was a bit of a sweatshop. And there was a financial advisor who got invited, I guess, into the office trying to drum up business. And I'm like, sure, I've got 10 grand. Let's invest it. So got into mutual funds and didn't know anything about anything. Uh, Visited the financial advisor once a year. Each time he had a different, I don't want to say scheme, that's sort of a negative word. He had a different direction for your portfolio. And so last time the theme was boomernomics, where it was for, for the aging population, which it turns out we were a little bit early. And next time it was US something or other, and he had a bunch of mutual funds lined up to cover that. Problem was he never sold the previous stuff. He never kind of reconciled the portfolio into the new version, the new annual version. And so my portfolio became a mess. And then back then you still had issues with RSPs that they had to be, I think, like 75% Canadian content and so on. I don't know. Okay, Daryl remembers. And so
Yeah,
you had to
I
have,
later knew it was 2000 when I started getting involved in stuff and got my first job.
okay.
So it was still a thing then.
Yeah. Like I started investing when I was 24, 25. I mean, it was in mutual funds. They didn't perform very well and they had high fees. I don't know if they were inappropriate for me because I was young and had a fairly long time horizon. I think they were okay. They just didn't perform very well. I mean, I think most of the gains were made in the early 90s, and I probably sort of got in too late for to kind of catch that. But anyways, but I started getting interested in fees because for those RSPs, in order for me to get the emerging markets equity that my financial advisor liked, you had to pay, I think, $200 a year for some kind of a wrapper that was able to get around that 80% or 75% Canadian content. And then next year you didn't need it anymore. There was something. So I'm like, okay, well, I don't want to pay it anymore. Well, you still have to pay it for this year, which was sort of like a penalty. So another $200. And, I was really cost conscious. And so I started learning more about it. And then one day at the library, I found a book by Morningstar where they explained how they do all of their rating system and so on. And so I learned a whole bunch about mutual funds. It was a total accident just walking through the shelves and I'm like, oh, Morningstar. So, and then I learned more and more. I was still living in my parents' basement, but due to their divorce, I ended up owning half the house to help my dad with the mortgage. And then eventually I met the lady that I now call my ex, and we bought a house together and cashed out all of those mutual funds. And Nothing. They stayed very flat. They didn't do anything. Okay. Um, Plus, there were deferred sales charges, which I had mentioned previously. And the financial advisor says, well, you didn't tell me you were going to need the money, so I put you into deferred sales charges. And so I paid like a 5% penalty or something for early withdrawal. It's like, after you told me you were going to need the money for a house, I started putting you into front end. And to be honest, I don't know, and I never knew how much he charged me on the front end, so I wouldn't have to pay the 5% on the back end if I sold early. So things were a lot different, and it was just ignorance that I didn't really enjoy. And so I just kept reading and learning more and more. And then I I started, and this was like early. I was with a software company through the dot-com crash, by the way, in 2002. Still with that, well, with a different software company, but so all of the stock options and stock that I had from that company just dove. And this was sort of my first mistake, I think, where I should have sold it, but I actually still had share certificates. Like, I had no idea how you actually transact these things, because I had what's it called? Recency bias, I think. Because you think, well, it's going up, it's going to keep going up forever. And I didn't need the money at the time, so why sell it? And that stock, it was a CRM company, customer relationship management. And it went up to $70 a share, then down to 50, then back to 70, and then the dot-com crash came in. Even though this was a viable company that actually made money, they just tanked along with everything else. And years later, I ended up getting rid of the stock for $2. So, take profits, I guess, is the lesson I learned there. And so uh, I started getting into individual stocks a little bit in kind of the mid 2000s, and those ended up being a disaster, including building up a position in BlackBerry, for example. I basically didn't really know exactly how it worked, or how to do research or anything like that. But I just started investing. And then 2008 came, and my assets that I had just went down actually faster than I could make the money. What was worse was that right around that time, or actually just tiny bit before it, is that my father wanted to sell the house that I owned half with him. And worst timing ever, sold the house. I ended up getting $230,000, which was a significant amount. Still had a financial advisor, different one than I started out with. And I knew enough about mutual funds at that point to be able to research and get 5-star mutual funds. So I picked a bunch of them. And it was like 2 Canadian, 2 US, 2 European, 2 like Far East, and then there was a bond fund. There was a single bond fund. And all together, that added up to about $200,000, because my financial advisor says, hey, listen, you have a lot of equity stuff here. You should put $30,000 into term deposit with the credit union where he was and where I was, obviously. And so I did. And again, recency bias. Hey, it's been going up that entire time. I bet it's going to continue. And in literally worst timing ever, it went up for another 2 months, and then it did nothing but go down in 2008. Like, did not touch the sides on the way down. The $200,000 became 130 on paper. I sold what used to be the 5-star mutual funds, which became 3-star mutual funds. I bought better ones. I sold the bond fund, which stayed flat. I sold that, reinvested that, and as I was earning money, kept investing that money. So even with the worst timing ever, by the way, that 200 grand is today worth 600. Okay, so it just shows that you could, if you do the right thing, because you can't see the future, but you react appropriately, you can still come out and do fairly well, is what I'm saying. And if I had just waited, then I mean I would have made out like a bandit. So then through, what was it, 2005 through to 2007, I got a really bad job. A job I should have quit, but it was a very short commute, so I could bike, and it was just horrendous. Like it was not working out. My boss and I didn't see eye to eye. I wasn't doing what he wanted. He wasn't doing what I wanted, and at that time, like that was what got me to, okay, you've been frugal and investing up until now, you really need to ratchet up. So I'm like, so if I had a million, I was making 70 grand at the time. Okay, I was like, okay, if you have $1 million and it just produces 5%, you could live on 50. You're my common law wife was working. I'm like, you'd be making the same as her. Just save that, and you don't have to do this anymore. You don't have to work anymore. And I quit the job, which I should have. And then 2008 came along. I got laid off from the new job that I got, and also took the opportunity to split from my ex. I stayed in the house, paid her out, and this is sort of my second learning that don't get divorced. Now we had a prenup, so that made things both easier and didn't cost me as much money as it would have otherwise. But if you split with your partner, you lose half your stuff, which sucks. So, um, yeah,
It can be worse.
what's that?
It can be worse.
It could be worse. I remember in the investing club where I am. Sorry, I'm going to go off on a bit of a tangent. I hope this is interesting to somebody. But it's there was a gentleman in the investing club who was coming out from further east, and like he had a long commute to attend physically. And he's like, yeah, sorry guys, I can't make it anymore. And then just in his goodbye email, he said, because we were always talking about investments, he said, my best investment, my wife, still holding. He's still like holding the investment. And on the outside, you're like, oh, that's romantic, that's sweet. And I later on, it dawned on me, I'm like, but she's also your greatest risk, because what you think is yours is actually only a half yours. So one day you could it could be that you only had half your stuff. So I didn't lose half my stuff, suffice it to say. And at that point, I also had, because I got laid off and because of the split, I had a little bit of time. And so I'm like, well, you know what? I got laid off several times over the course of my career. Why work permanent? And then I just started contracting. I got a corporation. So tax wise, I started earning like immediately. I earned like 60% more than I did when I was working permanent. Plus, with the corporation, it all became very tax efficient. and I just kept learning more. Prior to my ex and I going our separate ways, we were closing in on 1 million. We were about 900 something. And then when we went our separate ways because of the prenup, I was worth 700. So the prenup saved me about 200K, 250. I've got a fly in here. Apologies. So, but once I started contracting, everything got invested. Like I was really living on very small amounts, and at that time, still a financial advisor said, you know, you've got a lot of equity in your home. There was no mortgage on it. You've got a lot of equity in your home. Why don't you invest uh, through a home equity line of credit? Now, he wanted me to invest with him instead because of the crash that they had in the US in 2008. 2008 was a bit of a pivotal year for me. I bought one house in Arizona. It immediately got rented. And because I bought it from a bank, from a foreclosure, it was like a third of the price that it used to be just a year ago. And then I bought a second house, and I'm like, you know, I should diversify away from Arizona. And I got into Nevada in Las Vegas for the next two. And each year I basically bought one, they all got rented. Um, but as I got more houses, I also discovered there's no passive real estate, passive income from real estate. Uh, you'd get, you know, a couple of emails a week and you'd have to deal with this, that, you'd have to phone, you'd have to send checks. I mean, I took sort of the cheap way out as well. I could have gotten myself a US checking account, a US credit card, and done all of that. I sort of try to do everything just with a US checking account in my Canadian credit union. Uh, and I kept mailing checks and then please arrive, you know. You had to think ahead so as not to be converting money back and forth because there's always a spread that the bank charges you. So there were a lot of additional things with it. It involved planning. So I'm pretty good at it, but it sort of, I'm like, if I get like a couple more, it becomes a full-time job, and it certainly didn't pay like a full-time job. But I mean, I could get $4,000 a month in US dollars income if there weren't any significant expenses that particular month. So, you know, I was sort of getting there, you know, building my empire. And you know, just kept working, kept getting paid more and more, and just kept investing more and more, and like really living on very little. Eventually, once I said, okay, I'm good at four houses, then I converted the home equity line of credit to a mortgage, and then a couple of years later, I sold the house and got the condo where I am now. And kind of the end was very early in 2020, before pandemic. I uh, I was at 3.3 million was my net worth at that point. And actually, on the Canadian moneytalk.ca, I've put a new tab where I'm gonna every month I'm gonna put my net worth, like a graph, so you guys can take a look as how it's been climbing. You can see the drop for 2020, and then the recent drop. It's somewhat interesting, fascinating to me because it's about me. I'm sure you guys won't get as much of a kick out of it. So at that point, I'm like, you know what? Like, I don't want to be here anymore. There was going to be a software release, which was just going to be a disaster, and being there until midnight. And even though as a contractor, I get paid by the hour, I'm just like, I don't need to be here anymore. I don't need to do this. Like, why do it? So I just give my notice, and that was it. Pandemic came along. Again, I did the right thing. I didn't sell anything. In fact, I'm sure you guys, some of you heard my story. I made myself a shopping list, and when the stock market dropped 20%, I started buying. And I usually bought about 5% increments. So for example, Bank of Nova Scotia, I liked, so I bought 3 times 5% increments. Something else, I maybe only bought 2 increments. And so started buying, and the stock market kept dropping. I bought a second time. Some of them I was done with. And then the market recovered. I happened to get lucky. But I mean, once something is down 20%, you're like, how much further can it go? So, and then I sold one of the US houses to pay all of that stuff off, and off we went. So the pandemic was great as far as my portfolio went. And then I took one more contract where somebody actually that I worked with previously approached me, and I worked for 5 months from home. They weren't hurting me. Nothing terrifying was happening. I'm not going to bring it out, but I made myself a little, like, advent calendars for Christmas. I made myself a little calendar with check boxes, and I was like a prisoner. I was checking off the days till my last day of the contract. And I'm just like, yeah, you can't really work anymore. And my income, my passive income kept going up, obviously, as I was getting rid of houses. I got less rent, but that money was getting invested into dividend payers, which were more tax efficient and generally paying more than the rent. Because with the houses, I bought them all for cash. They wouldn't lend to foreigners at that time, and it's all from the HELOC from the house. And so because there was no leverage, I was getting like 2 or 3% return from the rents, and that was getting taxed. So yeah, at this point, I just my passive income kept going up and up. So now I'm over 100K, and I still live on 30. So yeah, so I haven't worked for like in a serious way. I haven't worked for 2.5 years, and I haven't worked for a year and a half. But I mean, working from home, I wasn't really really serious about it. So yeah, yeah. That's sort of my story. I started doing the YouTube channel a couple of years ago, and then about a year and a half the TikTok channel, and then of course I put up a website a couple of months back, and that sort of ties everything together. So anyway, that's my story. Let me get through the text messages, and then if you guys have any questions. Okay, so that was that. We talked about the TD brokerage. DE was asking, can get to this after your story. Dividend versus growth investing, mix or both? How to break up with advisor, transfer out, message after, or email first to let them know. Wow, a lot of stuff there. So okay, dividend versus growth. So let's say value investing versus growth investing, because value means either inexpensive, meaning low PE and low price to book, and or pays dividend, versus growth, which is a company that's, let's say, expensive now as far as the PE technology, let's say, but it is expected to go up further. So maybe expensive, but expected to get more expensive. For the last 10 years, growth investing, because of the cheap money, has beat value investing for the first 9 years. It's only once interest rates started going up, or there was a threat of them going up, did value take off. Growth investing also involves a lot of forward-looking expectations, where the company has great business idea perhaps, but it's not making money today. And so its price is based on the money that it's going to make in the future. And there's something called the discounted cash flow model that's used, where it to value what the company's worth today by adding up all of the future income that is expected and hoped for, but discounting it to the present time value of money using whatever the interest rate is. And as interest rates go up, those future cash flows are going to be worth less. So immediately when interest rates go up, these models suddenly value all these growth investments less. Okay, so that's just the definitions. Depends on what you want from your portfolio, I guess, would be the answer. If you don't necessarily need the money, or if you're willing to sell a couple of shares in order to get grocery money, you can do growth. If you do need the money, so anybody who's retired, let's say, dividend investing and value investing would be the way to go. Also, dividend payers usually, not always, can be bigger companies, which don't have as much volatility. But growth companies, you've seen some of the tech, if you've been following the reports for Q3, they can have pretty big swings, while if something bad happens, if they have a bad quarter. But if Royal Bank has a bad quarter, they'll come down 5%, not 20 like Facebook just did. But by the way, over 100-year period, you can look this up, value investing beats growth by a significant amount. It's just because of the cheap money and the low interest rates that growth has done well in the first 9 years of the last 10. Now, if you don't have very much money, but you still don't want to work, then you can use stuff like covered call ETFs and split corps. I don't like those, but they will get you high cash flow, like in the double digits. So if you have 500 grand and you desperately hate your job, you can invest in stuff like that, and they'll give you 10% plus cash flow, but you're missing out on any growth that the dividend payers would have if you actually held the stock normally. So the answer is depends what you want from your portfolio, whether you should be in dividend versus growth investing. If you need cash flow, then dividends are fine. If you don't mind selling a couple of shares now and again, you can still get cash flow from growth. If you want growth, I would like total return. Historically, again, value investing is what I'm going for. So I've for the last literally decade, I've been creating a portfolio with that in mind. So I'm in Canadian tax efficient, Canadian eligible dividend paying stocks. I pay, the $6.95 or $6.75 that my brokerage charges me. With Wealthsimple, I don't pay anything anymore. And then they just pay me dividends, and there's no other fees, and it's all tax efficient in my non-registered accounts.
Can I just interrupt?
Of course.
So things like VGRO and VEQT, like these index funds, those are single funds, ETFs. They're not built, they pay a dividend, but it's very minimal, I think. So like from what I've seen from reading about FIRE, it's like low cost ETFs like these, self-balancing funds or whatever.
Yeah.
You can just invest in that for most of your life until when you get closer to retirement. That's when you would convert that to the dividend payers or to a dividend paying ETF. Is that accurate?
You can do that for sure. As I've said, they may not actually outperform the dividend payers. Depending on which study you read, sometimes they say that the dividends are 2/3 of the total return. But I mean, if you buy index funds, then they should hopefully be averaging somewhere in the high single digits. American ones have done a little bit better. They might be 10%. They don't pay any dividends. If you get into dividend payers, then they'll pay 6-7% maybe yields, and then you'll get some growth, not as much as the tech stocks. So what you described, that is a viable strategy. If the total return is better on the growth ETFs, and then don't do it in the last year, start converting earlier on, so you split up the capital gains over multiple years. You can also convert only what you need to live on, and then just leave the rest growing. Again, assuming that it grows more than the dividend payers, which, like I said, historically it doesn't. And then those covered call ETFs, they don't appreciate at all. They just kick off that cash. So that is certainly a viable strategy. Some people will stay in the growth ETFs forever, and then they'll just sell, every 3 months they'll sell a couple of shares to cover them for the 3 months of living expenses. So, do your research, find the right ones, look over a 10-year period, which have had the biggest return. Probably because of what I said, for the last 10 years, the growth ones will. If you look further back, you may not get the same, information. So, yeah, I think just doing a little bit of math will probably let you know. If, like, everybody likes, by the way, everybody likes getting dividends. Nobody likes digging into the principal, right? Dividends aren't free money, just to be clear. I know I'm doing the exact same thing, but people like them. Retirees like dividends because you're not digging into your principal. And if your principal is also appreciating, then you're like, woohoo. But if you have a $10 stock, which pays a $1 dividend, you now have a $9 stock and $1 in cash. Dividends aren't free. It's just, you don't see the drop in the stock price because there's other movements that day when they announce the dividend. But that's just what, I think it's actually the ex-dividend date of the stock that it happens. So, I think investing is the most important thing. If you get an extra 0.5% here or there, sure, over 30 years it makes a difference, but I think it's important to start. As far as the strategy, I mean, read all the articles and then sort of make up your own mind. I think everybody has a slightly different theory. So, but to get to the second question, how to break up with an advisor: transfer out and message after, or email first to let them know? You may liken it to breaking up with a significant other. Do you break up with them and then tell them to come get their stuff, or throw their stuff out on the front lawn and then call them? I'm teasing. So, you know what? It's nothing personal to them. People transfer in, people transfer out. I've transferred out of a lot of advisors, and generally you don't hear from them. I don't think they're crying in their office. They just saw you as a source of money and bonuses, and they're like, okay, well, I guess I'm missing out on that commission that I was getting. But I mean, if you had a good relationship with them, you just say, hey, listen, I think I know enough to do it on my own. Like, I don't want to pay the commissions. And, like, they need to sell you what they're selling you to make the commissions in order to put food on a table, or because their manager tells them to. So, like, they're not bad people. If they're performing poorly, or the stuff they put you into is performing poorly, or they're not giving you good service, it's your money. Like, you need to do what you need to do. It's just, you could give them a courtesy email. I mean, if you want to give them feedback, If the problem is that they're meeting with you once a year and then they just go through your statement with you and they're not really adding any value, you can say, hey, listen, I need you to look over my entire portfolio, look at my financial life holistically. I know you don't get paid for advising me on my rental properties, but I would really like you to include them in your thinking. And I want to talk to you about them. If they're not willing to do that, for example, if that's what you want, I'm not saying that's what you want, then you say, hey, I got to find somebody who will help me, or if you're not going to help me, I can do this myself. Like I can find good mutual funds and good ETFs myself. So you can give them feedback and give them a second chance if you like them or you like working with them. Otherwise, transfer out, give it a couple of weeks, send them an email and say, hey, this wasn't working. Thanks for your time. I just depends on how you feel about them.
Yeah. Okay. It's a connection through family and whatnot. And
Okay.
so it's a little bit trickier, but something I have to consider. But yeah, it's really the fees that are bothering me. The service is good. I do get it, the plan, they do the plan, speak on a quarterly basis, if not more often. So there is services there, but at the same time, I'm thinking like low cost index funds. I don't want to be paying this fee, it's going to cut my returns in half over 30 years.
Yeah, it's definitely a drag on performance. But like I showed you, if they do have you in good mutual funds, they will outperform the ETFs even after fees. If they have you in crappy mutual funds, then no. Remember the blue, the red, and the yellow lines from last time?
Yeah. There's not much mutual funds. It's mostly individual stock picks. And I've actually been a proponent of adding like VTI and a few other indexes, but now they're coming back and saying, oh, you've got a lot in these index funds. We should break that apart and put them back into our model, which is more the individuals. They're doing the stock picking. They're actively managing it. So,
well, if they're outperforming the index, then let them. They're successful at it. See, here's the thing. It's a fee only, and you're paying them like 1% or something like that of your assets, I'm guessing, right?
it's above 1. Yeah.
Okay, yeah. So as long as they're outperforming the index, they'll outperform the ETFs as well. The thing is, if you start second guessing them and you start telling them what to buy, then you're paying them that 1+% for nothing because you're doing it yourself. So yeah, you might as well just pull the money, right?
Yeah. Cool. Appreciate it. Thanks.
Yeah. Okay, so moving on. Okay, what was Deborah referring to? Oh, TD brokerage and mutual funds. Okay. Okay. So I'm just one question then. So Deborah's saying, I'm stressed to meet with the TD guy to transfer the mutual fund series. How long does the money have to sit at a brokerage before you can move it again? Like usually moving stuff from brokerage to brokerage could take 2 to 4 weeks very easily, probably 3 to 4 weeks, let's say. It takes a while for everything to sort of settle and do that. If you can transfer to a different series and it lets you do it, then you're fine. Then I guess everything has settled enough. But it's if you do something too early, like if all the numbers aren't there or if stuff is missing, then you want to leave it before. A financial advisor would tell you probably, and you can transfer stuff when they say that it's ready. Now, a financial advisor will only leave will only let you have certain series, the stuff that pays them commission, unless you're paying them separately. Like if you're doing a fee only where you're paying a percentage of assets, then they'll do Series F for you, which has lower MERS. But a financial advisor will not put you into like do-it-yourself mutual funds, either because their boss tells them not to, or just because they won't get any commission off of it. If you have a huge amount of money and you say, oh, I really want to try out this mutual fund that is do-it-yourself, and it's 1% of your portfolio, then they'll do it as long as you keep your other stuff with them. But if that's the only thing that you have with them, they're like, no, I'm not getting paid for it. Like, I'm not going to give you financial advice for free. So so there's that aspect to look at. Let's see, was there anything I missed? We talked about that. Yeah, so I think I'm up to date as far as the questions go.
I got
anything-
kind of something maybe.
Of course, Jason.
Okay, so I guess yeah, I'm a little late to start in the game. I know that your classic saying is the best time to invest is yesterday, and so yeah, so I guess I'm late to that game, but you know, I wasn't that fortunate before, and now I'm kind of in a good spot now. And so I want to get started. So I'm getting financially literate, which is there's a lot, you know, there's a lot. So I really definitely appreciate all of your teachings, and you know, I'm going through all of your material, which is great. So would you suggest for me, like, I know I'll be shopping around for like a financial advisor, because I'd like to be able to go through, you know, what's my annual salary, and then I have kids, and then so I want to really take everything in charge. But until that happens, I was thinking probably the easiest, simplest way is, for example, Wealthsimple. You can choose a portfolio that fits with your type of risk aversion, and then do monthly increments, or you know, just drop it in, yeah, and then just let them, because I've already started, so I've seen kind of how the mechanics work, because I was kind of worried about how the mechanics work as well. But then I just started, and then I did the one where you can pick stocks yourself, and I was following your advices as well as to what your thoughts were on the market today, this week, last week, that kind of stuff, right? So I did some just so I can see the purchases, what it looks like. So I did the Enbridge, you know, because there's dividend payouts on that. I wasn't able to see how you could automatically reinvest those dividends, but anyways, that's okay. And then I saw the other one where you can choose a portfolio type, and then you just say, you know, I want to do like $250 a month or whatever, and then they just pick the ETFs for you. And there's like gold, and there's all sorts of other things that they automatically purchase for you. Would you say that that's at least a good start?
For sure. So let me go back to the beginning of your question. So every financial advisor that I've ever had, when you joined them at their bank or whatever they were, they always did a financial plan. It wasn't a budget. It was a financial plan. So it was like, okay, how much are you expecting to be investing? And then once you retire, how much do you think you'll need to pull out per year? And then they said, okay, you're going to run out of money when you're 89. So how long do you think you'll live? Right? And if you run out of money at 75, then they say, well, you're either going to have to spend less in retirement, or you're going to have to invest more in order to sort of get you into the 80s. So that's a financial plan. it's not a comprehensive one. If generally they won't help you with budgeting, they'll just say, okay, what are you able to invest? So as far as like what your salary needs to be and so on, you can do financial planning, which is sort of like that, but it can be more comprehensive. It can include all of your finances. You may wish to include, if you have a significant other, you can sort of put everything together as well. And the thing is, this plan needs to be updated every year because it's a forecast. And as time goes, what is forecasted became reality. And you can say, well, we thought we would have this much in assets, but actually we have more or less. So you can also compare to see how the last year went, whether it went according to the plan or not. But as you get closer to that retirement, you can start tweaking things, or you should start tweaking things, and the sooner you do it, the better. So you can do it yourself in Excel, back of the napkin, whatever, but a financial advisor probably won't do it probably as much detail as you would like, and they won't do it year after year generally, unless you ask them.
So then what would you be your advice if I'd really like to be able to do is kind of like, here's my annual salary, here's my wife's annual salary, we have 2 small children, and this is kind of our objectives of life, and how do we maximize, our income tax, like how do we minimize the income tax, and then how do we maximize the investments, that kind of stuff. What kind of person would I need to get to help me with that exercise?
Well, I mean, the more you earn, the more taxes you pay. If you're in a high tax bracket like we talked about, then use RRSPs instead of let's say a TFSA or non-registered. Yeah, I mean, you're always gonna be paying taxes, and if you're earning a lot, then you're gonna be paying a lot in taxes, but that's a nice problem to have. The fact that there's 2 of you and you're able to split your income is a lot better. If it was a single, like 2 people earning 50 grand each is way better from a tax perspective than one person earning 100,000, right? So there's that. I mean, an accountant might help you as well. The other thought that I had was the other thought I had was, why are you trying to get a financial advisor if you sort of want to do the investing yourself? Because the financial advisor, if you go to a bank, they're going to get you either into ETFs or more likely just mutual funds. So if you know enough to do it yourself, or you just want to go simple, you can do it yourself. Moving on to Wealthsimple, they sort of have 2 branches. One where they do it for you, but then you're paying them like what, 0.5%, right? And then they do it all for you. Or kind of what I'm doing is you just buy your own stuff. Now, there's no fees on that side, but for example, I started a monthly purchase plan, but it's not a purchase plan, it's a transfer plan. They just pull $500 out of my checking account every month, they put it into my TFSA, and then I have to log into my TFSA with Wealthsimple, and I make my own purchases. So if you're on the side, like the robo-advisor side, then I'm assuming that they make the purchases for you automatically, but then you're paying them that 0.5%, which you have to ask yourself whether they're adding value or whether you could pick a couple of ETFs yourself.
Okay.
I think I'm doing the same thing you are with Wealthsimple. I just have them transfer the money to a TFSA, and then I invest it myself. So I'm saving 0.5% by doing that.
Yeah,
Because
but
I looked at what my girlfriend did, and the robo-advisor put her into stuff that I thought, what I know now, which is great, this looks like bad planning for her.
Oh, like.
And
from
so I
a-
thought because I wouldn't agree with it, I wouldn't go with the robo advisor. So I ended up just trying to figure out how to do it myself.
Okay.
But
Um,
is Wealthsimple going to charge like other fees for, is the fee for if I try and buy a mutual fund through Wealthsimple going to be different than if I bought the same mutual fund through Qtrade or something?
yeah, Wealthsimple doesn't do mutual funds, by the way.
Oh, so
Yeah.
stock. If I'm trying to
Yeah.
pick a stock.
Well, so with what I'm doing, I can buy ETFs and stocks without any fees. With what Jason was talking about, then he fills out 20 questions that get his risk profile, and then based on that, they'll put them into 4 or 5 ETFs. And I'm assuming that if you want to do $500 a month, they will distribute that 500 into the ETFs appropriately, and you don't have to worry about it.
But that has a fee.
That has a fee. I think it's 0.5% to start off of the assets. So I mean, if you're starting out, it's not horrible. If you have $1 million, it ends up being pricier, and you're like, I could probably get a human to do that. But like Jason, if you've been educating yourself, you could probably do it yourself as well. So now what did Financial Planning Association of Canada directory? Yeah, it sounds like you need a financial planner. Now they will, so the reason a financial advisor does an so financial plan for you is because they're expecting you to buy mutual funds through them and transfer over your existing assets, which they usually promptly sell, and they will buy stuff through them, so that way they start getting the commissions. That's standard.
Right.
If it's in an RSP or TFSA, not a big deal, no tax implication. If it's in a non-registered account, then that sort of sucks. They shouldn't be doing that. But the reason they do the financial plan for free is because they're getting commissions through the mutual funds that they're about to sell you or already sold you. If you go to a financial planner, they will ask for a fee. So it'll probably be a couple of grand. So just a heads up with that. So check that out. Once you have enough assets, getting somebody who gets paid by the hour to check stuff over is a good idea. I haven't done it yet. I've gotten a couple of people to look at my portfolio, kind of in exchange for me looking at their portfolio. But fee only becomes a great idea, like paid by the hour, once you accumulate enough of a nest egg. But at the beginning, the commissions ends up being the cheaper version, or doing it yourself. So I hope that answers. Does that answer your question?
Yeah, it does. Thank you.
In all honesty, I don't see why you don't, like, you could do it yourself. Like, there's budgeting software and so on. I built out, David saw my spreadsheet. I built out a spreadsheet that sort of does what you're looking for. It doesn't take a horrendous amount of time to do it in Excel if you're good in Excel. So you could probably do it yourself if you wanted to.
Hey, Jason.
Yeah. Sure.
Just a suggestion, you're talking about budgeting. There's lots of free Google spreadsheets or Excel spreadsheets on, the internet. I use it for Google Sheets. I downloaded one, and I find it very helpful because I track all my spending in there now, and everything from rent to restaurants to bus tickets or whatever it is. Like, there's different categories. So that gives you an insight. I don't know if you're already tracking your budget on a daily basis, but if you are, that's awesome. It's very helpful because then you get a sense over the months, and then especially over the year, like what your expenses are and which categories. And then from there, once you have your budget in line, like Ailes is saying,
Alesh.
Ellis, sorry, my bad. Then yeah, like obviously the financial planning aspect comes into play. So if you want someone to review your portfolio or construct or give you advice in that regard, there are fee only planners. I gave some links there in the chat. Which will
Yeah,
probably cost
I
you.
clicked on those, so I'll save those and take a look at them later. Thank you very much. I certainly appreciate all the feedback, guys. But yeah, so I do have like an Excel budget file, and I'm somewhat of a geek, and I download my monthly. I download my transactions from my bank statement and from my credit card statement, and I've categorized all of the different spending types, so I'm able to understand what kind of money I'm dishing out on all sorts of dumb stuff. So that's good. And really now it's kind of like, okay, so now I know I have, 35% or 38% of my income that I could now invest in something and do something more lucrative than just dumping it in my checkings account.
Yeah.
And that's where I'm kind of at. And I'm like, okay, well, this is kind of overwhelming. So yeah, but great feedback. Thank you.
So like the robo advisors, they will charge Wealthsimple, whatever 0.5%, I think it was, for the robo advisor account, where the benefit of the robo advisors from what I've been reading is, and I'm considering it myself even, it's hands off. Like you sort of pick the portfolio based on the questionnaire for your risk level, and then they will automatically withdraw that money from your bank. So you don't have to log into the system every 2 weeks when you get paid and buy the stock manually like you would on Qtrade or Questrade. Although that's not to say you couldn't set up something like that, but generally speaking, it's more hands off through those robo advisors.
Yeah, that's and then that's what I've experienced in the last couple of months, I guess, is basically I've done both on Wealthsimple. I've done both so that I can sort of get a feel for what it means for me and what kind of stuff is happening. I did fill out the questions, like you had mentioned, 20 questions. So apparently I'm very avert to risk. So I'm at risk level 2, which says conservative. So essentially says equity 35% and fixed income and gold 65%. And if I view the holding, it says right now equity 35%. So there's global equities 10%, US equities 9%, emerging markets 6%, international equities 5%, Canadian equities 4%, and then it's fixed income and gold. So Canadian aggregate bond 37%, government bonds 16%, company bonds 8%, gold 2.5%, and cash 0.3%. So that's what the robot decided for me.
Right. So if
a lot of these robot, those will go based on like how you feel emotionally, not where do you have risk. So you taught us about how, like, do you need it in 5 years or might you need it next year? And that changes your risk. The questions, I went through the robo advisor and Wealthsimple, and it felt like they were more saying, how nervous do you feel? And it's like, well, I want like to get the maximum return. And I know I'm not going to need this money because I have other money and other incomes. I'm not going to need this money that I'm putting in Wealthsimple until retirement. So I know I got a long time. And so I'm not too risk averse according to what I learned here. And now that I'm educated, I'm also less risk averse because now I know what these questions mean. So yeah, how you answer them, I think because we're answering them in English and not as finance people, we become more risk averse than we probably should once we become educated.
Yeah, education definitely improves your risk friendliness because you know what's going on. You don't have to follow the daily news and watch CNBC or anything. You just know more about it, and things don't scare you once you know them or know about them. Jason, when do you think you'll need the money back? That would sort of be one of the primary things.
Well, now that I also know about the emergency bucket and what was the other bucket? The something cool happens and you want to invest bucket.
The
dry
advantage
powder
bucket or taking
opportunity bucket, right?
Opportunity, that's the good word. Yeah.
Yeah. So now that I know those, I'd like to be able to save up to have those buckets. I don't have those buckets right now. And then the rest, then it really is for retirement. So probably 20 years.
So I mean, based on that, and assuming that you know, if there's a loss in the market, that you're not going to totally freaked out, I would say that's very equity light. Like you need more equities. That would sort of be my perception of it.
Yeah.
Somebody who's 35% in equities is probably like 70 years old or something. You know, like that.
Well,
That's,
again, like Daryl was saying, I guess it really is like the questions they're asking is kind of like steering me towards, well, you know, that's making me nervous or whatever. And all of a sudden, well, my risk level is number 2, which is super conservative according to the answers, you know.
Right. It's like, right, when you answer the questions, the way they pose them made me feel very nervous. But since I've taken this webinar, I'm kind of like, yeah, I definitely would not go with what Wealthsimple's robo-advisor told me to do, knowing what I know now. It's just a simple little bit of education. I still don't know how to pick stocks. I don't know how to do stuff, but I do understand that, yeah, if I'm not going to need this money in 15 years, I shouldn't be buying bonds.
yeah.
Right. Yeah, I think also for myself, I didn't understand that. My fear was always, if it goes down, it's not going to come back up. And there is, I guess, potentially that risk maybe, but if it all goes to hell, I mean, we got bigger problems to deal with, like as a society, right? Like if it never returns, if the stocks tank to zero, which is never going to happen, I don't think.
Yeah, then you
It's
want to be
going to come
investing
back.
in canned
It's going to
goods.
come back. Like if you look at the boom and bust cycles, it's usually there's more. I think you showed this graph earlier in the webinars, more green than reds,
Yeah.
right?
Yeah.
You know what, if you look at a 50-year trend, you can definitely see the upward trend. If it has a bunch of bumps, and when that bump is happening to you, that doesn't feel real good. But like I sleep super well. Like you know, there's all these swings, and I'm like, I know it's going to come back up. Like I don't freak out. Now, if the Wealthsimple questionnaire is more about kind of the psychological part of investing, and it's concentrating on, you know, are you going to freak out if you lose money? And then it's saying, okay, well, we're going to go super conservative just so you feel comfortable, but that's taking away from the long-term returns. So, you
Yeah,
know,
they basically go on what I knew when I did it, and I didn't know a lot, and so I was very conservative. Like 3 webinars, and all of a sudden I'm kind of like, okay, now I'm very, very risk friendly.
okay, all right.
But I'm talking about according to their survey.
Right.
Am I still going to go out and start like doing like puts and stuff? No, like that's no. That's,
Yeah.
I do not know enough to do that. But would I want something that, like, I've realized over like the next 10 or 15 years, if like a drop happens, I know that a few years after that it comes back up. So if I see a drop and I know I only have like 5 years left to retirement, then I'll start getting a little nervous and I'll say, oh, when it starts going back up again, then I might switch over to like dividends or bonds or something like that. But I now know what I need to do, as opposed to, you're just going to stick me in something that's going to be very flat and conservative for like the rest of my investing. No, that's a bad idea.
Yeah.
I want it. I want to review it every year. And should I change it this year? I want to review it every 5 years, because I've seen like things happen in 5-year, 10-year, 30-year increments. So yeah, I know about diversification now. If I have things in like 3 different buckets and one of them's doing well and I need some money, I can switch that over to being money. Whereas if I have like 2 others or 3 others that aren't doing well, then I'll just leave them, because I know 5 years from now they might be doing better.
Mm-hmm. Yeah, that's a good way of looking at it. The amount of time until you need the money back, and keep in mind, during retirement, you don't need all of your money back all at once. Hopefully you're going to live another 20 years, So at least some of your investments should still be in stocks because they technically have a 20-year time frame. So just I don't think any of this is really super difficult. I'm gonna borrow a quote from somebody. It getting to financial independence isn't complicated, but it's not always easy. So like you can do it really simply. It's just kind of sticking to it and just keep doing the right thing over and over, and it will eventually work out. So I kind of look at that way. So
Yeah.
yeah,
For me, it's like I didn't know what any of this was. So it's kind of like I'm going from random, which is gambling, to I'm just going to go with what an advisor tells me to do. And my company said, hey, we're a big Fortune 500 company. We're going to give you mutual funds. And they basically had one guy talk to us for an hour once. And what he said made no sense to me. It wasn't that I didn't get anything from him. I didn't even know what to ask. And he didn't volunteer it. And most of the people in the room were just kind of like,
yeah,
and so now I look back at some of those investments from previous companies I look at, and it's like, I put like $100,000 into something. It's now worth like $130,000 after 20 years. And I'm like, yeah, that was bad.
yeah. Yeah.
But
It's even
now I know how I can pick stuff in it, and I know I know how to read the reports they send me, because they send you these reports and they don't tell you what those little grids mean, or what a 5-star versus a 4-star is, or what the MERS are. And so yeah, I just was stupid. And you give an uneducated guy a bunch of data, he doesn't know what to do with it.
yeah.
Now
You
I
don't
kind of
know.
do.
You don't. Yeah. If you don't know how to turn data into information, it's tough. So like even if you have a financial advisor and you just sort of nod away at everything, and you dread the quarterly meetings because you don't know what's happening, the financial advisor isn't going out of their way, unfortunately, to educate you, because they're afraid that then you'll leave them. So if you learn and you know how to ask the right questions, or you know what the right questions are, you know you're able to have an intelligent conversation with your financial advisor and challenge them on things, and then off you go. If you want to have a financial advisor, some people don't have the time, or at least it's not their preference of how to spend their time, and so they want to pay for a financial advisor. Great. If you find this even vaguely interesting and you want to take charge of your own money, you can do it yourself. I don't really see why not. To get some sample portfolios, go to that Canadian Couch Potato, and you can you can just implement it yourself on Wealthsimple. By the way, just kind of an interesting thing about Wealthsimple. Daryl and I kind of found the same thing, that it's not a monthly purchase, it's a monthly transfer, and then you have to go in and make the purchase yourself. But when I was doing the same thing with Qtrade, I picked 3 mutual funds or 4 mutual funds, and I said 200 into this one, 300 into this one. They pulled $1,000 out of my checking account and actually bought those shares for me. So I'm like, that's pretty cool. To be fair, it's a little harder with ETFs, because those have variable prices and you buy them by the dollar, not by the share. But like, I think they could have implemented something where you could say, I want you to buy these things for me automatically in Wealthsimple. But you get what you pay for, I guess, is the bottom line. But yeah, good stuff, guys. Any other questions? I'm not sure how long we're in, but
How do we know when you put out, you said you were going to be doing one on like how to read like stock information, like what PE and ratios and all that other stuff was. When are you going to do that?
I did a video on the YouTube channel not long ago.
Okay.
I think it was I can't remember exactly what it was called, but it was evaluating mutual funds or something like that, or
Yeah, you have only like a dozen, I think, on your channel, so it's easy to just find it.
yeah, it was recent, I think. Well, on the YouTube channel, there's a couple of hundred videos because I've been at it for a couple of
Yeah, there's a lot of stuff.
Is there? Maybe I was looking at the wrong thing.
Yeah,
Because
no,
I went
I've
to
been
YouTube and I
going.
subscribed to, oh, I know what it is. It's the YouTube channel for these recordings. But you have another one?
no, no, Canadian Money Talk. Maybe go to the videos tab as opposed to
Yeah,
to
it's
the home one.
okay. Yeah. Yeah, and I can always search for it.
Yeah.
So if I search just for stock, it should find it.
No, it would have been. Sorry, I was thinking of mutual.
Individual stock evaluation advanced.
Yeah, that's another seminar that I did once. But yeah, you can read through that. I do want to or watch through that. I do want to do a course at some point, but that's a little ways away. If you're starting out, though, as I said previously, ETFs and mutual funds would probably be the way to go. Individual stocks. If you want to learn about it, great. I did one about evaluating mutual funds. That's what I was thinking of. So that's a fairly recent one that I did.